Can I say hello to everyone on this afternoon? Paul and I will have a little chat about the things that we've had some chats about. We've covered topics which involve inflation, the setting of interest rates and quantitative easing. There have been quite a lot of people who've put in questions that they would like us to deal with in regard to these things, and again I will try and reflect the theoretical side of things, and Paul is going to give us the reality of what really happens. And I suppose the first couple of questions are almost reality questions, which I should put Paul's way, because they're people's concerns about the extent to which the Monetary Policy Committee of the Bank of England ends up following the Federal Reserve, following other central banks, or do they feel that they are acting independently of all other banks, and with concern mainly for UK policy? And a similar question to that was a person who asked if central banks really do act as a cartel and chat about things and decide whether or not all their policies should be similar. So let me throw the first part of that to Paul and ask him the extent to which he feels the Monetary Policy Committee is led by the decisions of other central banks, or does he feel that it's really a leader in the decision-making sector?
Well, I can absolutely say that the Monetary Policy Committee will set monetary policy for the UK based on its reading of the UK economy and without taking into account decisions that may or may not be made elsewhere. But what happens in the rest of the world does of course affect the UK economy, and so it does have to be taken into account to that extent. Now, if you look at the developed Western economies, actually most of the shocks that are going on in one economy are going on in all economies at the same time. There will be a few which are very specific. You'll have Trump shocks in the US, and we have Brexit here, and you'll have something else in Europe. But things like the pandemic, things like the general business cycle tend to get quite coordinated. And what you will see if you follow the patterns is that sometimes some countries are ahead. So, for example, during the Great Financial Crisis, the US was generally 6 to 9 months ahead of the UK economy. And if you know that, and if markets know that, they can look at what the US are doing and then expect everybody else to be doing something similar 6 to 9 months later. But this is really just a reflection of all of the factors which are hitting the UK economy. It's not because the MPC here are trying to copy what the US have done. And often we've seen the particular detail of policies or the language used be somewhat different. Now, having said that, do central banks act as a cartel? Well, actually the central banks do get together regularly, every 2 months in Basel, and they have a series of meetings. They have one meeting they call the Global Economy Meeting, where there's about 20 speakers around the table from all of the developed economy central banks and some of the less developed central banks. So India and China will always be there. Sometimes some of the smaller countries will have a seat, and they will share information. So everybody knows what is going on everywhere else, basically from the other person's point of view. So there shouldn't be any huge surprises about the state of the economy overseas, and then everybody has to reflect that back into their own economies. The UK, of course, is a particularly open economy. We export and import about 30% of GDP. The EU as a bloc and the US are much more closed as economies, and in fact the UK is one of their major trading partners. So it matters perhaps more to us than it does to some other countries. And the final part of the answer is, of course, the exchange rate. If we would have very high interest rates in the UK, exceptionally tight monetary policy, say, and it was loose in the States, you would expect sterling to rise against the dollar. That would put some temporary downward pressure on the UK economy and the inflation, because our real exchange rate might go temporarily out of line. And so you've also got to keep into account that external factor of what's happening to your exchange rate. But again, we don't target the exchange rate. It's just one thing which feeds into the calculation of where interest rates or the quantity of money needs to be for the UK economy.
Good, lovely. Thanks for that one, Paul. There's a question that has come out quite often and comments by a lot of people who think that the Bank of England is just an arm of government. It's directed by government, by the Treasury. It does what it's told, and that it has no real independence, despite what happened in 1997 when it was given independence. And people really would like Paul to address this issue. Does he really feel the Bank of England is making independent decisions in relation to the UK economy, or are they just listening to what the government and the Treasury says and following those guidelines? And in the same vein, would Paul be able to indicate any examples of where the Bank of England, during his period of time at the Bank of England, any examples of the bank going against what government really wanted of them?
Yeah, so it's an interesting question actually, and there's a lot of misunderstanding about central bank independence. As an institution, the Bank of England is not really independent. Okay, the government is its sole shareholder. It is obliged to pay half of its profits over to the government. The government appoints the governor and all the deputy governors and all the external MPC members. When I was an MPC member, I was the only member who was not appointed by the government, except for the chief economist, who was also appointed by the bank. At that point. Now there's just one. It's only the chief economist who's not appointed by the government. The Bank of England is part of the public sector. It operates, its self-styled mission is to operate in the public good, but the legislation which binds it and gives it its mandate all comes from government. The MPC itself acts to an annual remit that is set by the government, which describes what price stability is to be taken as. So the 2% target is set each year in that letter. And the government also sets out its wider economic policies, and the Bank of England's committees have secondary objectives that make it obliged to try to support wider government objectives. So there is actually quite a lot of influence of the government in all of that. The important point about independence is that the Monetary Policy Committee decisions on policy have to be independent of whatever the government might say. And the government, in the UK at least, never makes public comments about what monetary policy should be. Sometimes individual politicians may have veered on that and are quickly told off if they say anything. And similarly, the Bank of England's Monetary Policy Committee never says anything about fiscal policy, not in public anyway. They may say something privately, or they may comment on the broader shape of fiscal policy if it's affecting monetary policy, but they won't criticise government for that. Now that independence for the setting of monetary policy is important, because we've seen in plenty of times in history and overseas where governments have adjusted interest rates in particular for short-term political gains, and that's led to a detriment in the economy, and markets get to not believe that governments will set interest rates properly, and hence you need that independent decision making. That is partly why we have 4 external members, and the government has never, to my knowledge, appointed a political person to the MPC, somebody who is known to be an arch political supporter. They all have their views, of course, and some support one side and some support the other, but that is not what they're talking about publicly at the time. And so you do get that balance. Now, the government has an observer at the Monetary Policy Committee, and they can speak if they're asked to by the governor. And in my experience, they were regularly asked to speak, but really about things like what were VAT receipts showing? What was the information that the government had which the MPC might not otherwise have? Things which might be private to the government could be shared. The MPC would get a briefing on the budget just before it was announced, but it didn't really need it very long before in advance, so that wasn't. But it would have a private briefing on the government. So there was some information flow. What there is not is any instruction from the government to the MPC as to what the decision should be. It never has been. And I can say that as an MPC member, I never had any instruction as to what to do, even from within the Bank of England, from the governor or anybody else. It was completely my decision. And so I think that is, we do have and have had independence, because both sides have behaved properly in terms of how the monetary policy decision is reached. Now, have there been examples where the bank has gone against the government? Well, at one level, of course, if the government doesn't say anything about monetary policy, you will never know. But I can tell you one case. I can't really speak about the bank or anybody else, but there was once when I got told off unofficially for something I said as an NPC member, because I had to do an interview with the Sun. No other NPC member would go near the Sun, and I tended to do the interviews that nobody else would want to do. And one of the complaints I made was the way in which rail fares, which of course I had to pay every year to get into London, were being linked, index linked to the inflation outturn. And I said this was a bad idea. And it's a bad idea because it automatically gives an extra inflation boost to the economy. So you get something like an oil price shock that puts relative prices up. Then along come all the rail companies, automatically jack up their prices as well. You don't want that. It's not that rail companies shouldn't set their own prices, they should. What they shouldn't do is slavishly follow the outturn for retail prices, because that adds to the inflationary problem. Anyway, I got told off about that because they thought that had gone too far for an NPC member, encroaching on government policy. But the fact that I could say it and nobody stopped me and the interview was duly published, I think is testament to the fact that you can say what you like. It's very hard, particularly for an external NPC member. Really, the government has got no control over what they say at all.
Good, thank you. You've actually probably answered this question, but I think at the time of the appointment of Mark Carney, there was a feeling that George Osborne and the sort of Chancellor of the Exchequer role was choosing somebody who he thought might be compliant and helpful to his particular policies. Is that a question that I can ask you?
I think it's come up all the time. Technically, the Governor of the Bank of England is a Crown appointment made by Her Majesty. In the past, it used to be made by the Prime Minister, but since Gordon Brown, it's become part of the remit of the Chancellor. And you don't get to select many governors of the Bank of England because they have long terms of offices, they tend to outlive the Chancellors. So they're very careful with this power. And it has in the past been quite difficult sometimes. They delayed the reappointment of Eddie George, and then they delayed the reappointment of Mervyn King. And both Mervyn and Eddie before him had been quite independent in their views, and it was generally thought that this was bad behaviour. And so they changed the appointment term of the governor to be one term of 8 years, I think it is. Mark didn't actually manage to serve 8 years. The idea being that government can't put pressure on the governor just before their reappointment to do that what they want. So that's been quite a good outcome. So I think we have had these tensions before, yes, with because of course the Chancellor of the Exchequer can actually change, whilst the governor is in office, and quite often the governor will have a longer period of office. But I don't think Mark Carney could have been said to be left or right. I don't think Mervyn King was a relatively free market monetarist thinking person, but he never really ran the bank entirely in that fashion. So you take into account somebody's economics, but we've never had a demagogue as governor, and I don't think we ever will. Andrew Bailey is really an all-round central banker, and I don't think there was ever any thought that he was appointed because of any political philosophy.
Only laughing because someone did make the comment, and I've forgotten all about it because it wasn't particularly serious, but they were asking the question, was Mark Carney appointed because he looked like James Bond? I'm sure that wasn't the case, so let's move on. Something Paul and I said in the chat about interest rate setting is that we would both like to see interest rates higher than they really are, and some people questioned this because I suppose they thought that Paul would be very much behind the current very low rates of interest. I'm not, as an economist. I don't see the benefit of having low rates of interest. I don't ever see the benefits of distorting with market prices if you can possibly do that. And a ZERP type policy, almost a zero interest rate policy, to my mind, causes problems, creates bubbles, creates an imbalance, if you like, between the savers who are really paying for the debtors to go into debt at very low rates. And I feel that there's an imbalance and a distortion, and I think to a certain extent Paul agreed with me, but it surprised quite a few people that we were both of a mind that interest rates should be higher than they are at this moment. So they asked me just to confirm that that's what we really thought. Well, it is what I think. Paul, is it?
Yeah, I mean, you could make a reasonable argument that interest rates need to be higher because there is the potential for higher inflation post-pandemic, and that higher interest rates might be needed to choke it off. That's not an argument I would personally make. My concern is that I've never seen the research or the underpinning that suggests that interest rates this low support the economy. And let's be clear, the reason we cut interest rates to this level in the first place was because we had the risk of negative inflation and we had very slow growth. And it was originally conceived of as a temporary measure in order to try to boost the growth rate to get inflation up and hence back on target. And here we are 12 years later, and we still have interest rates very, very low. And whilst we've had growth around trend, we've never caught up with where we had expected to have been. And when you look at the economics for how low interest rates are supposed to support the economy, the arguments are actually quite weak. It's to do with shifting income between savers and borrowers and making spending more attractive to saving. And we just don't know what those effects are like when interest rates are this low. We've never, prior to the Great Financial Crisis, had any experience of it in hundreds of years of history. We'd never had low interest rates so low. I think 2% had been the lowest previous recorded bank rate. So there was no evidence to base it on. And there's reasons to suspect that as interest rates go close to zero, you start to get non-linear impacts come in, which can distort what the normal impact are. And we knew the impacts were not very strong in normal times. We know that if you jack interest rates up enough, you can slow down the economy. We know that if you print enough money, you can generate inflation. But the precise relationship between interest rates and inflation is actually quite weak. It really works through signals. And so I've just never really managed to convince myself that we have managed to support the economy through low interest rates. I suspect that if interest rates were a bit higher, actually markets would work better, savers would allocate money more efficiently. Instead of leaving it on your bank account, you might actually look for something productive to put your savings into, and that could build the real growth rate. I can remember the monetarists, who I don't claim to be a monetarist, but I can remember the monetarists arguing that in the long run, higher interest rates go with a stronger economy, higher growth. And whilst there's a question of what the causality is, i.e. higher growth should cause higher interest rates, it's not clear to me that we haven't helped drag the growth rate down with such low interest rates for so long. And I think there has been opportunity to put rates up. We probably didn't take that because of Brexit, which is one of the things, reasons why I wouldn't have done Brexit at that point in time. The US did get interest rates up, but then a combination of Trump and the pandemic forced them back down again. So we've had an unfortunate series of events which has prevented us getting interest rates back up, and it would have been very interesting to see what would happen to the growth rate if we actually had nominal interest rates a bit higher.
Yes, thanks. We did make the point last time, or I particularly made the point last time with interest rates, that it is very difficult for one central bank to act alone in terms of not creating volatility on exchange rates. And I have made the suggestion in the past that perhaps this is one area where central banks should get together and agree that yes, interest rates should be higher, and all move them at a similar rate at a similar time, setting a target perhaps for well, I would go a few percentage points myself above whatever the current inflation rate is, but then that would be a rather big jump. Admittedly, it could be done over quarter point moves every 2 months, something along those lines. But it does lead us to something else, which was a question that could follow on from this. People wanted to know, bearing in mind that Andrew Bailey and others have talked about nominal negative interest rates, and that these should be in the Bank of England's toolkit. Because neither of us think interest rates should be as low as they are, I would not myself go towards negative nominal interest rates. Paul, do you think it was ever serious that the Bank of England might have taken us into negative nominal interest rate territory?
Oh yes, it's been done overseas. And I think there have been times in the UK when market interest rates have actually gone negative for a short period. And in fact, if you looked at the real interest rate curve derived from index-linked gilts, that's been negative along the whole curve now for some years.
Yeah.
But was it likely we would set bank rate to be negative? I would have been very much against that, I have to say. There are a number of practical reasons, first of all, which is back in the Great Financial Crisis, we weren't certain that people's computer systems could handle negative interest rate because they'd all been written on the assumption. It's a bit like the year 2000 problem. People had already always written these on the assumption that interest rates would be positive. So at least twice the bank has done exercises with the banking sector to check that negative interest rates would work. And indeed, over time, because it happened in so many other countries, people got used to putting that into the systems. A second thing we had back in 2009, which my colleagues were more worried about than I was, and this is on the public record, is that some financial institutions, particularly building societies, had put limits to the deposit rates on their contracts. And as interest rates came down, they were in danger of going bust, basically. If we'd cut market rates and they couldn't cut the rates they were paying out, they could have been in serious trouble. Now, again, some years later, it was checked and that was no longer the case. Those contracts had all worn off, so it's not a reason now. But I think the main reason is, again, we just don't know whether going into negative interest rates stimulates the economy. We just don't know. Other countries where it's been done, the impetus to growth has been almost non-existent. And so I think it will be very reluctant, given that you can always expand the money supply. I think people would have been very reluctant to go into negative rates. But it has been seriously considered.
Yeah, I think if you take sort of just a standard economic argument, you can say if interest rates are lower, people borrow more money. If people borrow more money, the economy expands, and so on. But I think we've got to a point where with low interest rates, we could be having the opposite effect, and it could be that we're dampening growth prospects and we are creating an imbalance in the economy that is damaging the real long-term trend for economic growth. And I suppose a final question based just upon that is the extent to which the Bank of England does feel responsible for having abandoned savers under policies which are ZERP-ish, a bank rate of 0.1%, or in real terms they are negative, as we know. As soon as the inflation rate is above the rate of interest, then we've got negative real rates of interest, and quite a lot of savers. I'm not, of course, because it's only old people, but quite a lot of savers are a little bit annoyed by the fact that go back 10, 15 years, they will be able to quite easily make in a safe form of savings 4, 5, 6% a year. Now they can make next to nothing with their savings. So do you feel that you've abandoned savers with these policies?
No, there's a very particular group that will have suffered, but it's not savers in general. So let me just explain this. So when you cut interest rates to zero, you have a number of impacts. What you do, apart from anything else, is push up asset prices. If you are a house owner, the value of your house will go up because of very low interest rates, and that has happened. If you invest in stocks and shares or bonds, again, your wealth will go up as interest rates go down. The bonds won't change; it will be a step change. So if you have a stocks and shares ISA, for example, that could be doing quite well. The group that will have suffered will be people who only have cash holdings in, say, current or savings accounts at banks, because they will be earning very little, and a certain number of people will have built up large cash savings and be spending those cash savings as the interest on those cash savings as their income. But anyone with more than a few £100 or a few £1,000 maybe should be looking at a wider range of financial assets and should really be getting financial advice as to what things they can do with their money which would protect them against low interest rates. Obviously investing in a house is one, and lots of people have done that either deliberately or accidentally. Yeah. So it's not true that savers have been abandoned. What is true generally is that loose monetary policy is intended to shift income from borrowers to savers. Sorry, so from savers to borrowers. And so that is the intention. You wouldn't normally expect to do that for 10 years, though. Which,
No, quite.
which is
It has gone on for much longer. I do remember, within a year or so, this was still considered the emergency rate, and things will soon be going back up to a normal level, and that still hasn't happened, has it? One thing, let me just say there, because I do have a clear distinction in my mind between savers and investors. Savers are those people with capital protected products, and investors are those people who put their money at risk, whether it is in terms of buying shares, buying stocks, buying property, buying a second home, whatever it may be. And I do feel a little sorry myself for those people out there who do not have any knowledge and would be just quite happy to have their capital protected and a rate of interest which was 1 or 2 percentage points at least above the rate of inflation. And I think some of those do feel let down, in the sense that they've almost been forced out of somewhere that they were comfortable, which was in savings, and to put their savings at risk with investments. And as Paul says, there are alternatives there, but these perhaps are not for the people who have no wisdom with regard to investments. And I know Paul said you need to get financial advice on this, but not always financial advisors get these things right, because there are these ups and downs in the market, and there is a sort of a rough rule of thumb that says that it's the experts who sell at just the point that all the amateurs buy, and the amateurs hold on, and then the amateurs end up selling just at the point that the professionals are coming back and buying. And it does illustrate that there is a difference in terms of the intellectual understanding of savings and investments, and I often feel that is a particular problem.
Certainly financial advisors won't allow you to take too much risk if you don't demonstrate a really good understanding of it, although quite why an understanding of risk means you want to take more, I've never understood, but that's what the financial advisors are constrained to do.
Right. Good. We have got some other questions, but it does look we don't really want to go on too long on just one session, because we know that you'll need to rush off and have a cup of tea and things of that sort. So I suggest that we stop there. We will go on to some other chats on macroeconomics, which will lead us back to answering some of these other questions. So hopefully you found it interesting listening to the reality of what's going on at the Bank of England, and it puts your mind at rest, and hopefully we'll add more questions to a later chat. So thank you very much for that, Paul, and we'll come back with another chat after this one.